Good afternoon, everybody. I think we're the last slot today, is that right? So I can't believe they gave the accountants, funders and bankers the last slot today. So there you go, here we are. Hope you had a good day. Thank you very much for staying, and I appreciate it's 5 o'clock, so we're going to have half an hour on this. And I'm delighted to have a great panel here. We'll get introductions in a minute. My name's Craig Holmes, as the man said. I'm a partner in a local corporate finance boutique called H&H, and essentially what we do is advise companies on M&A activity, fundraising, raising money from private equity, venture capital and banks and the like of that. So I've worked with all these folk in terms of different companies I've worked with in terms of funding those companies. And really I suppose what we're going to try and do in this next half hour is I suppose try and talk through the different types of funding that's available for companies and specifically for technology companies, what the processes are in terms of achieving that funding, and what sort of, for each of the different types of funders, what specifically they're looking for in terms of both size and quantum of funding and also stage and how they want to see that process go in terms of applying for that funding. So what I'm going to do first of all is ask each of the folk here to introduce themselves and their organisation and just give you a little background in terms of what their organisation does, and then once we've done that we'll go into a bit more about what they're looking for and the processes to achieve that funding. So I'm going to start with Julianne.
I'm lucky. My name's Julianne O'Hare. I'm a director in business banking in Bank of Ireland, and effectively what the bank does is it provides both bank funding and a range of funding products as well as the wider financial services products in terms of advisory products for export finance and invoice discounting, all that full range of products of funding and services to businesses in Northern Ireland. And I've been with the bank for a long time now and funded businesses from a very early startup stage right through to public flotations, businesses that are dependent on the local economy, purely domestic businesses and businesses with global reach. So hopefully I'll be able to add something today.
Thank you very much, Julianne. Jayne?
Hi, my name is Jayne Brady and I'm a partner with Kernel Capital, who are a venture capital company. In Northern Ireland we manage the Bank of Ireland, Kernel Capital Growth Fund. It's part of Invest Northern Ireland's Access to Finance Continuum. It's a 25 million fund looking to invest in high potential startup companies, export focused. Kernel itself was founded in 2002 and it's raised about 140 million pounds sterling over that period. We have a number of different funds. Actually, Bank of Ireland are cornerstone investors in all our funds, but we're an all-Ireland fund and we have 7 funds under management, both for a variety of different stages of companies, all high potential startup companies, but at the seed and the growth stage. We've got about 70 investee companies at the moment, and we've got about 1,000 employees as part of those investee companies.
Thank you very much. Neil?
Neil Sims from Clarendon Fund Managers. We've managed over the years a series of VC funds that only invest in Northern Ireland. Most recent is called Co-Fund NI. It's slightly unusual in that it's a match fund that matches against private investors, so business angels or corporate investors coming into a company, and we'll invest on pari passu terms alongside those private investors. Typical round size is about 250 to half a million. I think our average round size is about 400, 430. We provide half that funding typically. It's been active for 3 years now, so we've invested about 5 million into 20 companies over the last 3 years. And there's no particular stage or sector, to be honest, but predominantly it's earlier stage companies. I'd say over half have been completely pre-revenue and probably 2 or 3 startup companies within that portfolio and across a wide range of sectors.
Thanks, Neil. Good, Mark?
Thanks, Ray. I'm Mark Fahy, although given I'm in Belfast, Mark Fahy might be more accurate. I head the UK small and mid-cap team at the London Stock Exchange. We're focused on supporting companies who are considering whether flotation might be something that they're looking to do moving forward. That's on both the AIM market, which is for smaller growing businesses, and also for the main market, which is for larger blue chip companies. I've been coming back and forwards to Belfast now for about 5 years. We're hopeful we have 1 or 2 candidates here for a flotation this year. and we've just had our best ever first quarter so far. So encouraging signs from our perspective.
Okay, so I think you can hopefully see we've got different types of funders here. We've got debt funders in the form of the bank. We've got venture capital, so private equity funders in the two VCs, and then we've got the sort of public flotation funders as well. So I'm going to actually now ask the guys to talk a wee bit more about the types of business and deals they would fund, what stage, and the sort of quantums they would look for, to give you a sense of how they would structure a deal, what types of opportunities they are specifically looking for from their organisation. And then we're going to, beyond that, we're going to ask them about the process of how you achieve that funding and what you need to do if you're a technology company to access that funding. So again, I'll start with Julianne. This case. So, Julianne, can you just talk us through, in terms of the bank specifically, I understand from in terms of technology companies, maybe the earlier stage companies may be more of a challenge. Can you just talk us through where you see the bank fitting into that process and the type of company you feel you could fund?
I suppose, Craig, the bank funds companies across all sectors, technology included, and I suppose in terms of how we approach any business proposition, it's very much the biggest question for us is getting to understand that business. So I suppose the first thing that we're looking for is someone approaching us is to be able to explain that business in as simple terms as you possibly can. And technology can be frightening for people who are not actually in the world of technology. So there is that bit of communication is key. So anyone thinking about approaching their bank, it's the elevator pitch. What does your business actually do? What is it trying to fix? What's the solution it's trying to fix? And what the risks are to that business. And then it's about the people, what you bring to the table as a person. In terms of sitting down to engage with your bank, we're very broad range of channels. You can access your bank today very online, all of your direct, easy channels. You can speak to the bank on the end of the phone, but I think particularly for us in Northern Ireland, we are very committed to having a wide network of business advisors and relationship managers who will sit down and talk you through that process. And I suppose a lot of early stage businesses will need more of an equity-based funding or seed capital, and the money, and the guys here will talk more about that, the family and friends money and that type of thing. But they also still need a bit of direction. Where are the other sources of funding that are available to them, but how best to manage and look at cash flow. And the bank and our business advisors would sit working with our businesses to help them understand those cash flow, building that up and that engagement. But it's very much about communication and a very clear story what the business is about, that you can articulate that, and that the bank, who are really financial people, can understand what your technology is and what you're bringing to the table. But the approach is very much the same as a business in any other sector. Okay,
but it would be fair to say that for a bank, any bank, it's going to be more challenging for very early stage companies because there may not be a cash flow that you can lend against or assets that you can secure against. So that is a challenge.
Very early stages, that would be very early stages. You'd be directing them. The most thing we'd be doing is writing where are those sources of funding into your venture capital funds or your early seed. The guys will pick that up further. It wouldn't be without the cash flow. If you ultimately think about it, debt is something that has to be repaid. So until you have the established cash flow revenues and generating positive cash flow that can repay that debt, bank debt funding wouldn't fit that early stage investment. You'd need to be avoiding it until the positive cash flows are coming through in the business. It's the other services, I think, that we would offer at that stage.
So opposite the debt, we've got equity, which is taking a percentage of shareholding in the business, so there's no repayment going through. So that's where the venture capital guys come in. So again, Jayne, if you can maybe walk through, from your point of view, from Kernel's point of view, what types of companies you're looking at in terms of size and stage and the sort of investment amounts you would look at typically, please.
Okay. So first of all, in terms of investment focus, we would look for areas, typically it's software, communications, network, chip design, and engineering. We do that for a number of reasons. Actually, one of the areas of tech for equity focus, but actually we have 6 partners, and about 50% of us come from the business background. I'm an engineer myself, electronic engineer, and I was worked for an investee company, for a Kernel Capital investee company for 6 years prior to joining Kernel. So what we try to do is we leverage skills that actually our team have. So we do the due diligence ourselves. We work with the companies in terms of the tech. And if we can't understand it, we probably won't invest in it, because we can't add any value. When you're looking for sources of funding, I guess you need to see the value that comes out of that. And that's why we focus on areas where we have the skills to bear. And that's kind of skills internally for our own connection that we can bring to it. But we've also got 70 investee companies, and that comes with it a large network. So those are also companies where we've invested, where we know we have skills. So that's kind of a key aspect that we bring to it. But another thing that we're really, really big in, and it was, been here the whole day, very interesting, but there was discussion earlier on agile methodologies, and there's a phraseology called the minimum viable product. And actually, I think we target that in terms of VC language, but what we're very keen on is being able to sell something early, and technology for technology's sake, refining your widget to the nth degree, without proving there is a commercial market for it, can be a very long and costly path, and you can make many slips along the way. So we are very keen to see companies who have deep tech and know their area, but actually have been able to prove that someone's going to pay for the thing, because actually through that process they'll learn a lot and they'll come back with a much more compelling proposition to that stage. So we're very, very eager in looking at companies who can prove that early. In terms of the different funds, from the Northern Ireland perspective, our fund isn't a seed fund, it's a growth fund. So it's looking to companies who have actually proven the technology's there and there's a market for it. And it's allowing companies then to access finance to get them to somewhere else if they can through organic growth. Our bite-size investments would be 450,000 up to 2 million. We typically would look to lead a Series A investment. Although we do syndicate, we've invested, I think, 40 million in the past 3 years, and syndicated that's up to 120 million. So we triple our money in terms of that. However, we would be seeking to kind of grow with the companies in Series A and bring them through to Series B, where we'd look for kind of an international investment, US investment, to get them up to that point.
And it's probably important to note that as a VC, you're ultimately looking for an exit as well. So can you maybe just give us 30 seconds on that, what that means? And
absolutely. And this is probably not typical either, but actually we're not exit focused at all. Craig.
Learned something.
Because a lot of companies, when we come in the seed stage, at the stage of seed, you have an idea and you've refined, you have an application, but actually there's a lifetime of 5, 7, 9 years where your direction will change. So actually we have found that if you invest in a good company with someone who knows their tech and who's been able to prove it in the market, that you will get an exit in some route. So that's proven. We've funds we're running the last over the last 10 years. We exited fund just at the end of November, the 22% net IRR, so reasonable returns. And so we're not focusing. I think it's to put in companies early on this pressure that they'll leave with 4 times multipliers via an acquisition route. Those are all fine things, and we'll invest in segments where there is a track record of being able to exit or an acquisition. But that's not something we put any effort into.
But exit is the way you get your money out. As opposed to bank, you get repaid along the journey. Yeah. You get your money at exit. So, but you're saying your focus isn't to try and say it's a 5-year exit. It can go longer because you're looking for the.
Well, no, that's a good point. Actually, just to clarify, so we do need to, so our fund is a 10-year fund. It's 5 years to invest. We're 6 months into it, and then it's 5 years to recoup our money. So we do need to return the money to our LPs to invest in and to Bank of Ireland. We need to do that. But our experience is that that's not something we focus with the company initially.
Okay.
But a company needs to appreciate.
But it's something it's something that the company's coming, you have to think about in terms of their plan and what they're proposing in terms of how that process works and where it actually ends up.
And actually to that point, because VC money isn't for everybody, and there's a lot of really very strong, solid companies in Northern Ireland who stay away from VC money because of that reason. That when you invest, when you take VC money, you lose control of part of your company because you have a VC there with you. So there is an expectation, that you'll go to raise further money, or there'll be, an exit via an IPO, hopefully, or a technology acquisition at some point. Yeah. So you're very well. Founders need to go in with the understanding that it comes with its cost.
Neil, can you do the same in terms of the funds you have available in terms of size and quantum and what stage you're looking for?
Well, we're not really prescriptive, as I said earlier. So we're driven by what private investors are interested in investing in. So round size has to be above 250 typically, but it's been anywhere from 250 up to about $1.5 million of funding in the initial rounds. We have an expectation that we'll be there to follow on the investment. So we always ask the investors we're investing alongside, do you have the capacity for some follow-on investment? And I would agree with Jayne. Companies always have to mention that long-term we're looking for an exit, but our focus is more on getting you to the next round of investment and how much money is the company going to have to raise in a given sector. So for some sectors like medtech or biotech, that there's a £5 to £10 million funding at least ahead of you. So you're not thinking about that end exit goal, you're thinking about how you get the company to a place where it's going to get the Kernel Crescent Series A type round and then beyond that. So we've invested in I think 3 medtech companies, 2 biotech, a couple of social media stroke gaming, some ICT, enterprise software, consumer goods. It's been a really broad, engineering companies, really broad mix. And as I said, it's going to be harder for you to raise above 250k at a complete startup seed stage, but if you can do it, we will look at investing in the companies. Typically, the companies that approach us have product proven, they've got maybe some early beta sales. I'd say over half of them are pre-sales as they come into us, but they've maybe got the product market ready. So they've normally been through that friends and family route, and the point that we come in is a new private investors who are making a commercial investment decision coming into the company. I wouldn't say those investors are typically altruistic, but they want to be interested in what they're investing in, so it isn't solely a commercial decision. So they've either got an interest in the sector, the space, they find the product proposition compelling. So if I was advising a company of how to best pitch yourself, it's make sure that it's very easily understood what you're trying to do, especially if it's in a complex tech area. So it's easy if it's a bubble bum or a consumer product where you just get it and you get the market opportunity. Where you're in an enterprise software space where you're having to explain exactly what you do, it can be quite a difficult sell to private investors. And the biggest thing for us is probably after the management team, and that's as much about personal relationships as it is about the strengths and skills of the management team, it's the route to market. So the size of the market's important in absolute terms, but unless you can get the market in the first instance, it doesn't really matter what size it is. And the investors take into account how much it's going to cost you to get to that marketplace. So if it's going to cost you 2 million to fully develop a product, 2-3 million in regulatory costs, even before you think about your sales and marketing tactics, the investors have to understand that on day one. If it's a social media thing where it's a bit of the dark arts of we'll put this out there and the buyers will come, and with a bit of online media campaign, which never quite proves to be the case, but it's a much simpler route to market and it's a much more easily understood route for the investors coming in. So.
Okay, so 2 VCs who aren't exit focused. Yeah, you heard it here first. I think it's probably fair to say, certainly from our experience as a corporate finance house, if you're, I suppose, maybe further up the food chain in terms of larger business, tech or any other sector, certainly the larger VCs, the guys who are doing the 10, 20, 30 millions are very exit focused, and I think the first thing they will ever ask is, where's the exit? So I appreciate, because of where you are in the stage, I totally understand that, trying to get to the next round of funding.
We always ask for it.
Yeah, I understand.
But we have an expectation that that's some way down the track.
I'm playing with you, don't worry. Mark, you're maybe slightly different. The other 3 folk are all based here and would be considered as part of the Northern Ireland business community. You are involved in the Northern Ireland business community, but based out of London. And I guess there's a perception, and maybe and wrongly perceived, that Northern Ireland companies aren't right for AIM or aren't right for flotation. I know we've had many conversations about that's not the case. And there's also a perception that the scale of it, that a business has to be before it's ready for a listing, it has to be far bigger than the reality. So again, can you talk us through some of that and dispel some of those myths and explain the types of companies you're looking for and why Northern Ireland companies actually are particularly right for it?
Yeah, sure. I mean, there's no difference of companies here than we find anywhere across the UK. They're as good as businesses we see all the time. So to give you examples of this, so last year we had a company join AIM called Aria. It was a university spin out from Aberdeen. It came to market in December. It raised £6 million. It's got revenue of less than £1 million, but it's got a fantastic growth opportunity in the big data space. So it's a really exciting area. It's got a lot to prove, but it's a very interesting story. And a second one, which was again a University of Leeds spin-out, which was based in Sheffield, which joined AIM in March, called Xeros. And Xeros, they make waterless washing machines, which use polymer beads to clean your clothes. So it's a hardware product, really fascinating business. I guess it could be another version of Dyson, ultimately. A long way to go. But again, very little revenue in that business. It's much more about the market opportunity and the management team. you get both of those right, you'll get lots of investor interest. And tech particularly is really back on the investors' radar. So last year we raised about £1 billion for technology companies on our markets. As of today, we're at 1.3 billion this year already. So it's a really significant appetite out there. And part of that is driven by the fact that investors clearly see the issues around growth across the world. It's a fairly low growth world we're in, and how do we buy growth? And technology companies often aren't bounded by the same things that you would see in more traditional businesses. So I think that's why the appetite's growing all the time. And also at the same time, the understanding of those businesses is also growing, particularly in the city, as people build out teams and analysts to understand those businesses a bit more clearly. So it's been a big shift in the mindset of the investors across the city. And just to add to that, the weight of money that's sat there seeking good investments is huge, and therefore many of the flotations we're seeing right now are very much focused on raising capital both at the point of flotation, but then going back time and again, and in virtually every situation they've been oversubscribed. So there's huge amounts of interest out there.
Okay, so you folk all have access to funds. You're willing to try and get it out in the marketplace. These guys want to get out. How do they do that? So Mark, I'll start with you. What's the process for connecting with yourselves and looking at whether opportunities in business and companies can access your particular type of fund? How do they go about that?
Yeah, sure. Well, ring me up or send me an email with the first starting point, clearly. No, we sit here, in my view, as a slightly more independent viewpoint on flotation. So our job effectively is to help companies understand why it might be the right thing for them to consider and why not. So it's really important for us that we get companies who come to market with the right strategy, the right rationale to join the market, because ultimately without that it can affect market credibility and it might be the wrong thing for a company to do. It might be actually that they need to go through a different form of funding first. So one of these guys perhaps can provide. And we see a lot of that right now, a lot of companies backed either by venture capital or private equity are now exiting onto a market. And that phrase exit actually is probably not accurate because it's not an exit, it's the next stage of the journey, particularly for the management. So in that sense, we're very, very focused on helping companies and support them through that initial learning and understanding. And just to kind of separate that out slightly, we're about to launch something called the Elite Programme later this month, and it's a 2-year management programme focused on supporting companies who want to scale, private companies, which is funding source neutral. So it's not about preparing for a flotation, it's about supporting companies who want to understand how they can scale and what the right way to fund that might be in the longer term. But just to go back to the point about how the process works, I'll focus on AIM. So AIM has these group of advisors called nominated advisors, nomads, and they are really the people, the stockbrokers, the corporate finance houses, the investment banks, who are very focused on assessing a company's suitability and appropriateness to join AIM, taking them through the flotation process, and then supporting them once they're on market. And we'd always say that companies, if they behave like a PLC, quite often, whatever exit route they go down, ultimately that can help enhance that. So I think preparing to be like a PLC is really important. And often, in our view, it's about engaging with the advisors early, getting some of these guys on board early to start that dialogue and that debate, and clearly use us as well.
Okay, thank you. Neil, can you tell us how we get their hands on your money?
Yeah. I'd start off by saying that there's never been a better time really to raise equity funding in Northern Ireland. So, as of next month, there'll be sort of 2 earlier stage tech funds in terms of co-fund and NISPO 2. You've got Jayne and Kernel, and you've got Crescent Capital. There's never been that much money available for people to go to, and an element of choice as well. So I think it's a good time for you as companies. The first point of contact for us is just to give us a ring and ask us about the process. I think you'll find that with all the local funds, nobody's going to turn you away and say, come back to us whenever you're ready to approach. Everybody will have an initial conversation, and nobody will look at something and then say, well, never darken my door again, it's a terrible idea. There's usually a bit of free advice to be given if you speak to the people within the organisations. And we, amongst others, like forming early relationships with people, because a fundraising process can be a sort of 6 to 12 month process in terms of the time you can pull all the different elements of the funding together. In practical terms, we won't fully engage with the company until you've identified at least some of your private investors. So we won't go out and fundraise and find all the private investment to leverage against. But if there's a gap, so if you're trying to raise $500,000, you've got 150 of private investors, we can make some introductions to try and fill out rounds. Once you've got that private investment, we help try and bring the round together. So we put a structure and a formal procedure around an investment round to try and bring the private investors together into a coherent group or a cohesive group. And often what you see in Northern Ireland, unlike other regions of the UK, is there isn't really formal syndicates of private investors. You've got organisations like Halo who will act as a conduit for putting companies in front of individuals, but there's no real structured syndicates of angel investors. So what we tend to bring together is informal networks of investors coming together as a group. And once they've done one deal, you'll find quite typically they'll go on and look at other deals together as well, and work alongside Wayne and other sort of local advisory community and trying to pull those investors together. For you as companies looking for that private investor engagement, you've got formal networks like Halo and HBAN in the south. Go to your advisors, go to your CF advisors, your accountants, your lawyers, your network, your mentors, companies that you work with, and just ask the question, do you know somebody who might be interested in investing in this company? And often it's the company's personal relationships that garner the largest degree of interest from private investors. Beyond that, once we've engaged, it's probably a sort of 2 to 3 month process in terms of pulling the investment round together. And it's quite there's no real structure to it because different groups of private investors treat it in different ways. But it's usually a fairly amicable process. And then after that, you've got an engagement with the private investors who will get involved with the company, at least one representative. We don't enforce board rights with companies, but we tend to have a sort of advisory relationship. So we stay in touch. We attend board meetings quarterly. In some cases, we do attend monthly board meetings, but by invitation rather than forcing ourselves on the companies. And we're there to try and help companies fundraise into the next round of investments. And we're early in our fund's life, so it's pretty good so far. There's been no really difficult conversations, and a lot of the companies are doing very well.
Okay. Jayne, briefly, could you talk us through Kernel's, how the guys approach you and try and access your funding?
Yeah, well, we're very committed to being here for the long term, and I am here for the long term. So we're very keen to meet companies whatever stage they're involved in. So, we've talked about the revenue profile, we're beyond the sea, but we're really keen to talk to any companies who foresee they will need investment at some stage. And as Neil says, we want to help companies get to whatever stage we need to grow successful companies and invest in them with us or with other of the VC entities. So we actually have a scheme called Open Hours where we go around the country and we leave ourselves kind of open to meet with anybody who wants to. My mother's thinking of booking in, actually my husband and children, quite possibly. But it's just on our website and you can book in terms of a slot. The only precondition we have is that we won't have read anything about your company in advance, but there'll be a couple of members of us in the team. We have sessions organised in Omagh, Newry, Derry and Belfast, and we run it in conjunction with Bank of Ireland Enterprise Week as well, so we can be in the Bank of Ireland's offices as well, so that's part of it. And the first thing is really to get to know the entrepreneur and the team, and really the investment decision, aside of the exit and the technology and everything else, is really all about the team. That's what it comes down to. And I have the utmost respect for someone who goes and starts their own company. It is a very, very difficult thing to do, and having been on the other side of it and worrying about paying people's wages and worrying about getting a mortgage yourself, they should be, applauded for doing that. But it's a two-way process, so we get to know them, and then they get to know us, because that's a big thing. This isn't just money. We will be with the company for the most formative stages of its business. So and then they should look around at all sorts of funds, Northern Ireland, Republic. They should make it very clear that that's the right decision for them. And so what we actually do is we provide access to our 70 of our CEOs, or phone numbers or email addresses, so they can phone them up and they'll hear good things and hear bad things. But that's part of that process because they need to know that it works. There will be many tricky times as part of that. And then should we go ahead, we'll go into due diligence process, and that'll be again probably working with the teams here in Belfast. So we'll go through the commercial, the technical, the product, and as part of that they'll get to know us as well through that. So it's usually the process we would say would take probably 3 months from it. We did our first investment in 21 days, wasn't it? But we'll never do that again. But I'm really glad I did it the first one.
Put that out there. Okay, great. Julian, you sort of alluded earlier in terms of how the bank likes to be approached. The personal touch, I guess, is also key. Is there anything else you want to kind of talk through in terms of what you're looking for from a business plan or a particular piece of funding?
And effectively, even if you think about the process that's involved there, and we do lead with a meeting. It's still our model. We have people locally right across the network, business advisors, relationship managers who will meet you. The information that we need is a plan, but it's not a plan this thick. It's keep it concise. It's all about keeping it simple and being able to talk to it that bankers can understand it. We struggle to understand some things sometimes, so keep it simple, explain exactly what the business is about, and then the main document, I suppose, on top of what explaining the business is the cash flow side of it. What is it? The ins and outs, what are the revenues that you're receiving, what have you to pay out, and that will give us and again keeping that simple but keeping it sophisticated enough to the level that you understand, that it clearly articulates what are your timings, articulating what the funding gap might be. So it's understanding not only what the business is about, but sitting with your business advisor or your relationship manager, what are the business's needs. You might initially come in at an early stage and we might have to say, well look, at this point in time, bank debt is not necessarily what you need. There are certain services that we can help you with, but it's a different type of funding. But that establishes a relationship, and an awful lot of this is about establishing that relationship, getting to understand the business, and maybe at a later stage then, a few months down the line, you've made the contact, you know the person, you speak to them again, and the business has moved on maybe a year, months in terms of the rapid growth of some of the technology businesses. But I think the key point that we make, and I think it's picking up on some of the things that people have said, it's once you build that understanding, you're building it hopefully for the long term. Like the bank can be there right through all of these various stages of funding, right through even whenever we have our listings. And we've funded technology companies from very, very early stages in Northern Ireland and still been involved in them whenever they have listed. And that's a bit, I think, about that it's important to build those relationships, be open, be clear in the communication, and keep it simple. And I know banks can overly complicate it, and something we're working at the minute is keeping those processes as simple, as streamlined, and as fast as possible for people. So there's a bit of technology investment going on in the financial services sector, I think, as well at the minute.
Okay, thank you all for that. I'd certainly recommend getting a good corporate finance advisor if you can. Okay, I think we're going to try and open the floor. I'm conscious of time here, so time up. Okay, can we have one set of questions? Is that okay? Anybody, any burning questions? No? We're either really good or really bad. No burning questions? Okay, so we've offered. Listen, thank you very much for bearing with us, and thank you all to the speakers tonight. So, thank you.